We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Laurent Lequeu from the Macro Butler Substack. Laurent, thanks for joining me today. How are you?
Thanks for having me. It's a pleasure to be on your show.
Well, I'm looking forward to this conversation today because, you're seeing things a lot differently than a lot of people are, let's say, for this coming year, for 2025. We're having this discussion, right? It's the 14th of January. We're, let's say, just over a week away from President Trump's inauguration. And there's, of course, a lot of changes, a lot of uncertainties that are all kind of being weighed right now. Many things are up in the air. So what do you think are the most important macro themes that you're evaluating at this time that are most impactful, do you think, for the year ahead?
Well, I look at the world through the lens of the business cycle. If you look at the current environment, the US is still in an inflationary boom. I mean, it has been since 2023 in this environment. So this has been a very good environment for equity performance. But what will change next week when President-elect Trump will be inaugurated is that he will first, I think, implement tariff, and this will clearly change the landscape of the world, because first it will not only imply that we will have a reflation wave coming into the US, but also it will impact global economic growth. And since the world is interconnected, if you have economic bust in Europe, in Japan, and elsewhere in the world, of course, it's difficult for the US to stay in a boom phase.
Mm-hmm. So please elaborate a little bit more on looking at things through the business cycle. What does this mean for the US at this time, and where is it headed to you?
Well, you can look at the economy between a boom and a bust, and between inflation and deflation. So rather than looking at economic data published by government, I just look at some market data. So in fact, there are three market ratio that really matters to evaluate if an economy is in a boom or in a bust, in deflation or inflation. So the first one is the S&P to oil ratio. So the S&P to oil ratio, if it's above its 7-year moving average, just tell you that the economy is in a good shape and companies are able to pass through input cost of energy to their customers, so that they are growing earnings. And this means that globally, the US economy is in a boom. This is still the case as of now. Then to look at the inflation or deflation environment, I just look at if treasuries are a good store of value versus gold. And here, if you look at the gold to treasury index, well, it has been below the 7-year moving average since the start of the 2020. So whatever the government and whatever Wall Street have been told us, in fact, inflation has started long time ago. And we are still in this inflationary environment. So this is kind of the 4 quadrant of the economy. And then I look at a third ratio, which is usually a leading indicator of where the US economy is leading, is the S&P to gold ratio. And here, in fact, the S&P to gold ratio as of today is still slightly above its 7-year moving average. But I would say that before the US election, in fact, this ratio trended down below the 7-year moving average, meaning that the market was already smelling issues coming. So of course, we all know we had this kind of Trump rally in November, but this rally faded in December. And again, if you look at, in fact, the performance of the S&P in gold terms in 2024, in fact, equities went down, were not up 25% in US dollars. So it means that there are big issues in the US economy, and I would say this could be the trigger of the US moving to the inflationary bust while it's still in the inflationary boom for the time being.
Mm-hmm. So does part of that, let's say, path forward for the US moving into this inflationary bust side of the cycle, does that have to do with Trump's tariffs? And if so, how do those proposals affect supply chains if they're going to be implemented, as he states?
Well, I guess that, the US, most of American companies are importing a lot of their goods, or a lot of part of the input cost is imported from outside. So if Trump implement tariff, this will inevitably have impact on the cost structure of corporate America. Of course, we all know that US corporation will pass through this higher cost to the consumer. But the issue is that we could see a decline in consumer confidence and some, I would say, threat of the strong consumer confidence that we have seen in November being tamed down. And this means, in fact, that you will see lower margins for US corporates. And intuitively, this will impact the performance of the S&P 500. So I come back to this S&P to oil ratio. It can move down below the 7-year moving average because the S&P goes down or because the oil goes up. So I guess this would be the result of the tariff. First would be a pressure on margin for corporate America, meaning that we will see a pullback in equity markets.
Mm-hmm. So, Laurent, does this mean that we're not necessarily headed for an inflationary period, as we saw, let's say, in 21 and 22 here, rather some, more so a stagflationary environment?
Well, I think that what I call inflationary bust, in fact, is a stagflation. And this means, from my indicators, in fact, the US was in a stagflation in 2022, and you remember 2022 was a very challenging year for investors, even in the bond market or in the equity market. So I guess that the risks are high that we are moving back into an environment similar to 2022. That's what we already have seen. In fact, over the past few months, we have seen the bond market being under pressure. And ultimately, this also translates into the economy because of higher borrowing costs for consumer, for entrepreneur, and also this would mean a pressure on financial markets.
Mm-hmm. So are there trends in the US right now that can be, let's say, extrapolated to the rest of the world, whether that be, let's say, unemployment trends, manufacturing, or inflationary numbers?
Well, I guess the US has benefited from a tight labor market since the COVID time. There were a lot of people exiting the workforce. This is what also we have seen elsewhere in the world. But I would say for the benefit of the US, we had some immigration. That was a reason that the job market was relatively stable. Here as well, if we look at one of the propositions of President-elect Trump is to tighten immigration. So this will ultimately also tighten the job market again. And this ultimately mean that higher wages, meaning higher costs for US corporates, meaning as well that margin for the S&P 500 companies are under pressure. So to come back to your question, I think that elsewhere in the world, Europe, Japan, and even China are importing most of their energy, while the US is a domestic energy supply. So I would think that the US is still in a better shape than other countries in the world, but ultimately we also move into this inflationary buzz in 2025.
So, Laurent, you were sharing with me before we hit record here today that you see the world a lot differently over the next year to four than a lot of people do. You're very contrarian in your thinking in this way. What are some of the biggest things that you think are going to surprise most people, let's say, over the next year?
Well, I think that the big difference between Trump 2.0 and Trump 1.0 is that when Trump took office in 2017, the US fridge was full, meaning that the government had a lot of leeway to give tax cut to the consumer. The US economy was in a very strong shape, and interest rates were much lower, as well as the debt level. Fast forward to 2025, in fact, the US fridge is kind of empty because rising debt, rising government debt, rising interest rate, a lot of spending around Medicare, as well as a lot of spending related to the wars that have started a few years ago. So I think that the shape of the US economy at the start of the second mandate of President Trump is very different. And therefore, while everyone was kind of cheerful about the election of Trump and thought that we are going into a 4-year Trump rally, in fact, the contrary could be inset.
Mm-hmm. So is it possible in your mind that the world actually gets surprised by more war or an escalation of these tensions around the world rather than less, as Trump has, vowed to try to bring peace to these conflicts?
Well, I guess here as well, I mean, if you remember during the campaign, Trump told us that he could stop the Ukraine war in 24 hours. I mean, it's no more the case now. He's looking to meet with Putin. And on the other side, he has asked Ukraine to reduce the age for conscription to 18 years old. So I mean, he seems to have changed his mind about the outcome of the Ukraine war. Time will tell if he can reach a deal with Putin. I think that from the Russian side, it would be much more difficult for Putin to strike a deal with Trump, because there's been a lot of loss of confidence from the Russian. I mean, in the Middle East, I think that in fact the fall of Syria over the past few weeks, in fact, has increased the instability in the region. So I don't think that Trump will be able to stabilize the region so easily. We have seen a rising threat from the Houthis against Israel. So we don't really see an easing of the war cycle in the Middle East. And I think that, in fact, a lot of people in Washington would be keen to open a new war in Asia. And here, I guess that the higher risk is on the Korean Peninsula, because I mean, you remember that the current U.S. administration has highlighted the role of North Korea in the war in Ukraine. So, and also there's political instability in South Korea. So, I mean. Desperate men do desperate things. So I think that the tension in the Korean Peninsula could rise dramatically over the next few months.
Mm-hmm. So, Laurent, I'd like to go back to talking a little bit about the Fed. It seems like Powell and Trump have been a little bit at odds over the past couple of years. do you think that the Fed's path forward right now is solid in regards to their rate paths and what their data is telling them?
Well, to be honest, in September, the US was in an inflationary boom, and as it still is. So there was no reason for the Fed to cut rate at that time. In fact, if you look at the Taylor rule, which I know some people think is outdated rule, the Fed fund rate should be at 6%. But I would say that the Fed has become increasingly irrelevant in the current environment because you can see that the bond vigilantes, the bond market is doing the work of the Fed. The 10-year yield is now up more than 100 basis points since the September rate cut. So it's telling you that the market is driving long-dated yields higher. And I guess that it shows that whatever the Fed will do in 2025, and I personally think that if they are really committed to their 2% inflation target, they would have to raise rates by the second half of the year. But on the other hand, anyway, I would say with long dated yields moving up, you have mortgage rates going up, you have car loans rates going up, and then a lot of US corporates will have to refinance around $1 trillion this year, meaning that they will have also to pay higher borrowing costs at the end of the day.
Mm-hmm. So why is it that you say that some people think that the Taylor rule is outdated? And does that mean, ideally, if they're supposed to be at 6%, that is the new market neutral rate for the Fed?
Well, I guess that the people are more looking at what the Fed is doing on the liquidity side as well, that on the interest rate side. So that's why the people are paying less and less attention to the Taylor rule. And you know that, I mean, the Fed has been very active in injecting shadow liquidity in the market because this is also what stimulates financial markets. But I would say if we look at that shadow liquidity or environment for 2025, it's also deteriorating. I mean, the reverse repo program is almost empty. The Fed balance sheet has been kept declining over the years. And the only way for injecting liquidity in the short term is through the TGA. Which I don't think that the new US secretary will use straight away because he will at least try to buy some times and look at how he can implement refinancing. I mean, investor must remember that there's almost 10 trillion US dollar of US government debt to be refinanced this year. So you take 10 trillion US dollar of US government debt, 1.5 trillion of US corporate debt, that's 11 trillion to find somewhere. So this impact financial markets. And so that's why I guess that in 2025 also what investor must realize is that the volatility will rise dramatically.
Mm-hmm. What other forms, you mentioned the reverse repo program, but what other forms of this shadow liquidity can people look at to kind of get a sense for what the Fed is actually pumping into the markets?
Well, I think that the first is the reverse repo facility. What the government could do is to impose banks and money market funds to invest even more in treasuries and potentially increase the duration of the money market fund. I mean, the government can decide whatever they want to keep the bond yields in check. But I would think that this would be a relief in terms of long dated yield, but ultimately, I mean, we will see much higher treasury yield this year. I won't be surprised to see 5.5% on the 10-year yield and above 6% on the 30-year yield.
Mm-hmm. So, Laurent, what countries in the world are in worse shape, and does this type of analysis really help inform your view on the path forward for how the world economy looks over the next 5 years?
Well, if you look at market data, China has been in a bust since the start of this decade. And there are very few, I would say, indicators that the economy is moving out of this economic bust. But I would think for China, again, it all depends of what the government will be keen to do to support the economy. I think that the Chinese government has always taken the view that they want to avoid this kind of mega stimulus that we have seen in the Western countries. I was saying that for China, the equity market doesn't really matter because most Chinese companies rely on bank loans to finance their growth. So what is important for China and the Chinese government is to keep the banks afloat and to give loans to their corporates. And in fact, that's what's happening, right? You have the Chinese 10-year bond yield at historically low level, meaning that everything is done to keep the banking sector in a relatively good shape. I would think when I look at the other major economies, Japan and Europe are in a much worse shape than the US. I mean, as I said, US is energy independent. Japan, Europe depend on energy supply from the Middle East or from other countries to run the economies. A lot of political instability in Europe, you can see in Germany, in France. It's kind of a political mess, so it's not really conducive for entrepreneurs to invest. And on top of this, for Europe, I mean, they have a war at their doorstep, so it's still a big issue for this region. So I think that I would say Japan and Europe are in the worst shape among the major economy. China is a bit isolated because of the way that the Chinese economy is working, and for the time being, the US is still the best economy in the world, and in fact, it is likely to remain the best. So when I say that the US will move into an inflationary burst or stagflation, I think that the impact of this US stagflation will be much worse for European and Japanese corporates than for American corporates.
So, Laurent, with all this uncertainty in the world, where do we put our money? What is your best friend in these uncertain times?
Well, if you look at, again, coming back on the four quadrant of the business cycle, and then I look at the bond portfolio, which is made of the four major asset class, cash, bond, equity, and gold. In fact, when the economy is in an inflationary mode, you only need to own gold and equities. So this should be the backbone. Equities and gold should be the backbone of every portfolio today. And when the economy moves from inflationary boom into inflationary bust, in fact, that's the time where you must overweight gold versus equity. So I would say that investors should own at least between 30 to 45% of their portfolio in physical gold. And the rest, in fact, should be spread between equities and cash. So, of course, in an inflationary environment, cash is not an asset that you want to own. But there are ways to manage actively cash. And I think here, short-dated investment-grade US dollar bonds are a very good way to manage actively cash. And then inside equities, in fact, once the economy moves from an inflationary boom into an inflationary bust, it's the time where energy producers, so meaning the oil and gas sector, outperform the energy consumer, which you can foresee by the IT sector. So I think that for this year, and I think this will be a big surprise for many, we could see the US energy sector outperforming the Magnificent Seven.
Interesting. What about gold-related equities and producers?
Oh, okay. So, I mean, gold equities or gold miners are still equities. So these are stocks that you can, I would say, add to the category of energy producer. I mean, when I mean energy producer, it's not only the oil and gas sector, it's also everything related to materials. So, and you can include the gold miners. I would think that for the gold miners, the issue that I always have is once the gold price goes very high, in fact, the countries who are hosting the mine are getting more and more greedy to get their share of the cake, meaning that they will change the regulation and they will raise taxes on the gold miners. So yes, the gold miners looks attractively valued today, but there are a lot of risk compared to physical gold.
Mm-hmm. So in that risky sector, are there specific things that you're looking for if you're going to be moving into any of those equities to really inform our audience on, what to look out for?
Well, I think that I mean, if you are looking to build a portfolio as of today, in the equity part of your portfolio, you should of course build a substantial position in the oil and gas sector. Another sector that I think is interesting and has historically done well during inflationary burst, and is because inflationary bursts are usually associated where a rising war cycle is the aerospace defense sector. So this is also one sector that I think will do well in 2025. I know that a lot of investors have been scared because of President-elect Trump cutting government budget and impacting the defense spending in the US, especially on the big military provider like Lockheed Martin, RTX, or Northrop Grumman. But historically, this sector has done very well in an inflationary burst as well.
Mm-hmm. I meant specifically within gold producers, Laurent. Do you have any insight to share there?
Well, I mean, I don't have a crystal ball of what's going to happen in Canada, but I think that in 2025 there will be a lot of political changes also in Canada. And I guess that I would say the regulatory environment in Canada can only be better under the new prime minister than during the past prime minister. So my view would be to look at Canadian gold miners, likely to do very well. I mean, historically, Canada has been quite a good jurisdiction for mining, and I guess the new government could be much more friendly for miners. And the same for the oil and gas sector. In fact, I think that the oil and gas sector in Canada is quite undervalued compared to the US oil and gas sector, and also it could benefit from a change in regulations.
Mm-hmm. Well, I couldn't agree with you more on that, but that remains to be seen how long all of those changes end up taking to play out.
Well, it's a long. I mean, it's a long. We could have to wait for a long time,
Mm-hmm.
but I would think that Canada. I mean, the issue that I see with Canada is the currency. I think that we will see a weaker Canadian dollar because, in fact, the US dollar will appreciate against all other currencies, and the Canadian dollar will be weakening against the US dollar as well.
Mm-hmm. In that vein, Laurent, is it instructive to you in some ways to be looking at gold in other currencies, not only the US dollar?
Well, I think that if you look at 2024, gold has done very well in all currencies. And it's also a sign that it was a global bull market for gold. And in fact, in my last newsletter, I look at the performance of other equity market than the S&P 500 in gold terms, and they have done much worse than the S&P 500 in gold terms. So I would say I think that we will see a very strong gold performance in other currency. At least I can say in Asia we will continue to see central banks buying gold to diversify outside of US dollar asset, because I don't think that the weaponization of US dollar asset will end with the new president.
Mm-hmm. Yeah, I think time will tell with that as well. But it makes me wonder how, let's say, how the world looks or how the gold price looks in other currencies versus the US dollar, let's say a year from now.
Oh, I think that if you take the gold performance in euro or in yen, it will be much higher than the gold performance in US dollar. Meaning that, in fact, gold is even more attractive for non-US investor than for US investor, in a way that, in fact, Europe is already in inflationary bust even before tariff has been implemented on European export to the US. So I guess that we will see a much weaker euro and a much higher gold euro exchange rate in the next 12 months.
Mm-hmm. And how about major indices or other commodities? Should we be measuring gold really by doing ratios of other commodities or other major indices, as you use those three ratios to tell you where the business cycle is headed?
Well, I guess that you can measure other commodities in gold terms, and this will give you kind of all these commodities are priced against gold, and meaning that what in the financial industry we usually do, we look at the copper price, copper to gold ratio, oil to gold ratio. If you look at the copper to gold ratio or the oil to gold ratio, they are at very attractive level, meaning that these commodities are very cheap, not only in US dollar terms, but they are even cheaper in gold terms. Mm-hmm. And this means, in fact, I guess that what we will see as well is that because I think the world is entering in kind of a period of supply chain disruption again. It can be because of tariff, because of war. In fact, you will see a massive re-rating of other commodities outside gold in US dollar terms and probably in gold terms. But I would say that this would depend, in gold terms, this would depend how bad the stagflation is in the next 12 to 24 months.
Mm-hmm. As we think about the importance of energy, Laurent, where does uranium fit into that picture for you? And since we've seen, a relatively big appreciation in the uranium spot price, term price, and equities over the past 2 years, do you think that has more room to run, or is it a very important piece of the energy picture for the world going forward?
Well, I think that for uranium, the picture is different between the US and the rest of the world. I mean, as I said, the US is blessed with ample natural gas and oil reserve. So it doesn't make any sense for the US to power its AI revolution with uranium. What makes sense for the US to power the AI revolution is to use the natural gas that is flared in the Permian. And that's why maybe here the drill baby drill comes into play, is that unless during the past 4 years, a lot of natural gas producer has flared their natural gas. Maybe under Trump, they will be able to use this natural gas to power AI. So for the US, because the US doesn't have such big uranium reserve, and in fact is depending on imports from Russia or Kazakhstan for uranium, I would think that uranium doesn't really make sense for the US. For the rest of the world, in fact, uranium is the solution. Because if you think about it, especially I take the example of China. China is highly reliant from oil coming from the Middle East and from Iran, especially. So if you are the Chinese government, you want to diversify your energy supply, right? So you can ask to get some supply from Russia in terms of oil and gas. But at the end of the day, one of the goals of the Belt Road Initiative from China was to connect China with the countries like Kazakhstan and Uzbekistan, where they can get their uranium. And in fact, in terms of development of the nuclear power, China is well ahead of the US, and that's why I think that for China it makes sense. In Europe, in fact, if you remember, after Charles de Gaulle, France was one of the leading countries using uranium to generate electricity. This has changed a lot because of the greenwashing prevailing in Europe and in France over the past 5 years. But again, here, if more realistic energy policy are implemented in Europe, in fact, Europe should focus more on uranium than on gas or oil. And so I think that for uranium, it's a mixed picture. You cannot say that uranium fits for all countries.
Mm-hmm. One of the other ratio charts I wanted to ask you about, Laurent, was the Bitcoin versus gold chart. What do you think that tells us, and is that instructive to you, in a more profound way than just, giving you that signal?
Well, in fact, what I find interesting of the Bitcoin to gold ratio is that it peaked just at the same time as the Nasdaq at the end of December. So it clearly gives you also that not only risk off has come or is coming, but it also gives us a signal of sector rotation inside the equity market. I mean, Bitcoin is a big user of energy. So going back to the theory of this inflationary bust, where corporates are not able to pass through higher input or higher energy prices to their customer. In fact, this clearly is also shown in the Bitcoin to gold ratio. So I think that this is kind of a good ratio to monitor in terms of risk allocation as well as sector allocation in the equity market.
Mm-hmm. Do we really know what happens to Bitcoin in these times of uncertainty or times of fear, that we're possibly going to see over the next year or two?
Well, I have some doubt about the origin of Bitcoin. I don't really believe into what I call the Satoshi Nakamoto fairy tale story. I would think that there are many things that are not really clear about the origin of Bitcoin. And on top of this, I mean, if you have suffer from hurricane disruption or any natural disaster disruption, you know that in such environment, there's no access to the power grid, there's no access to the internet. So, I mean, having Bitcoin will not really help you in terms of preserving your wealth, or while I would say owning a gold coin will always be seen as a source of preserving wealth. On top of this, I would say that Bitcoin, I would say, has been politically used to buy votes in the US during the last presidential campaign. And if you are a real Bitcoin believer, you wouldn't want the US government to own a Bitcoin reserve. You wouldn't want to see the political establishment being involved in Bitcoin, because at the end of the day, Bitcoin is the libertarian kind of way of living.
Mm-hmm. Laurent, as we wrap up here, is there anything that you'd like to leave our listeners to think about before we do?
Well, I think that people must be aware that the next few years will be challenging, but there's always a bright side of the story. I think that managing risk is very important and will be even more important in the years to come. Investors over the past 2 years have been used to buy the dips and see double-digit returns on almost everything. I think we are going into an environment which is much more volatile, much more challenging for investors, and they must stay disciplined. They must also try to minimize drawdown, and that's the way that they will build their wealth for the future.
Mm-hmm. Excellent, Laurent. I really appreciate your time today. For those that want to hear more or read more of your work, you do the Macro Butler Substack. Excellent weekly review of what happened and what you're looking at, as well as some interesting podcasts. Is there anywhere else you'd like to point to our audience to find you?
No, they can find me on Substack. I'm also on X and on LinkedIn. That's where they can find me.
Wonderful. Laurent, thanks so much for your time today.
Thank you very much.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.